take a listen to some of the central bank governors as they decide on interest rate decision and make those announcements. We're starting with this round from South Africa.
The MPC decided to reduce the policy rate by 25 basis points to 7.75% with effect from the 22nd of November 2024. The decision was unanimous. The committee agreed that reducing the level of policy restrictiveness is still consistent with achieving the inflation target. The risk outlook, however, requires a cautious approach. Global interest rates could well shift higher again, and the recent rand depreciation demonstrates how rapidly changes in the global environment can affect South Africa. The forecast sees rates easing further in future, stabilizing a bit above 7%. But this rate path from the quarterly projection model remains a broad policy guide. The MPC would like to emphasize that its decisions will be made on a meeting-by-meeting basis with no forward guidance and no pre-commitment to any specific rate path. Such decisions will continue to be outlook-dependent, responsive to data developments, and sensitive to the balance of risks to the forecast. There are scenarios where inflation is higher than in our baseline. During this meeting, the MPC explored two such scenarios. One assumed higher administered price inflation. The other envisioned a more difficult external environment with a weaker rand and higher oil prices. We also considered a favorable scenario where geopolitical tensions subside and the oil price falls. These risks underscored the uncertainty surrounding the outlook. Given a challenging external environment, it remains crucial to sustain domestic reform momentum. This entails both structural reforms to support growth capacity and macroeconomic efforts to rebuild fiscal and monetary policy space. The MPC's main contribution is to deliver low and stable inflation with well-anchored inflation expectations. Additional measures that would improve economic conditions include reaching a prudent public debt level, further repairing and strengthening network industries, lowering administered price inflation, and keeping real wage growth in line with productivity gains.
We decided to reduce the repo rate by 25 basis points to 7.5%, to continue supporting the domestic economy while simultaneously safeguarding the peg between the Namibia dollar and the South African rand. The decision was made following a comprehensive review of domestic, regional, and international developments. Let us consider recent economic developments in Namibia. The Namibian economy recovery continued during the first 6 months of 2024, although growth is forecast to decelerate for 2024 as a whole. Inflation continued to moderate while the growth in private sector credit extension remained subdued. The merchandise trade deficit widened further while the stock of international reserves remained sufficient to support the currency peg and meet the country's international financial obligations. Domestic economic activity rose during the first half of 2024 relative to the same period in 2023. However, growth is expected to slow in 2024. While the increase in economic activity during the first half of the year was broad-based, it primarily emanated from the mining, electricity generation, wholesale and retail trade, tourism, communication, and transport sectors, as well as the livestock marketing subsector. Looking ahead, growth in Namibia's real gross domestic product is projected to decelerate to 3.1% in 2024, from 4.2% in 2023. This revised projected growth is 0.6 percentage point lower than the forecast at the previous MPC meeting. The slower growth is anticipated to be mainly driven by a slowdown in the primary industry, partly reflecting the prevailing drought conditions. Risk to the domestic economy, stemming from both external and domestic factors, have remained broadly unchanged since the previous MPC meeting.
In the case of Sub-Saharan Africa, the growth for 2024 has been revised downwards by 0.1, and that also reflects the revised growth in Nigeria by 0.2%, so that now Nigeria is growing by 3.1 rather than the previous 3.3%. By way of comparison, Kenya's growth in last year was 5.6%. And that was higher than, obviously, the global growth. It was higher than the advanced economies, and was also higher than the average for the emerging market and developing economies, which recorded a growth of 4.4%. And for Sub-Saharan Africa, the average growth was 3.4 compared to 5.6 in the case of Kenya. And going forward, the same pertains in 2024 as well as in 2025, where the average growth for Kenya is higher than the other regional averages. In the case of the global financial markets, the markets have remained stable, and this has been reflected in the improved performance in the equity markets. And to a certain extent, this improvement in the equity markets reflects improved global economic conditions, and also the easing of eased financial market access for the emerging and developing economies should result from this stable global financial markets, particularly as the advanced economies start to lower their interest rates. And we hope that that will reduce the cost of funding, and that emerging economies and developing economies can access international capital markets at reduced interest rates. So the key takeaways on the global developments are the following: that global growth remains steady in 2024, supported by strong growth in the US, but also improved growth prospects in China as well as India. The risk to the global growth outlook relates to the elevated geopolitical risks, particularly the war in the Middle East and increased uncertainties with respect to political factors such as the elections in some of the major economies.
Geopolitical tensions, if this intensify, and then the disruption of trade leading to sustained increases in shipping costs or commodity prices, thereby lowering the global growth and further limiting the domestic economy's supply capacity. And if the weather conditions become extreme, this could drive food prices higher than projected. Overall, the risk to inflation outlook are balanced. On economic activity has remained strong with output around its potential. High frequency indicators of economic activity and business sentiment suggests sustained strengthening in economic activity driven by resilient domestic expenditure. The GDP growth outlook remains unchanged since the October 2024 monetary policy statement, with growth expected to be between 6% and 6.5% in financial year 2024/25 and between 7% and 7.5% over the medium term. This growth trajectory is supported by strategic government interventions, increased foreign direct investment in the extractive industry, and the commencement of oil production in financial year 2025/26. Also, this growth outlook remains under considerable uncertainty. On the downside, growth could be lower if heightened geopolitical risks and potential changes to global trade and fiscal policies trigger additional economic shocks, disrupting trade and supply chains and resulting in higher commodity prices, especially oil. Also, the ongoing tightness in the domestic financial conditions, if this persists, could lead to higher borrowing costs and increased domestic borrowing to finance fiscal deficits may crowd out the private sector and worsen the already limited private sector credit. And also, if the capacity of fiscal policy to respond to emerging global shocks is constrained, we could see growth lower. But on the upside, growth could be higher if government interventions result in improvements in productivity growth, and if investment is stronger in the extractive industry, and also if the global economy picks up, supporting exports, remittances, tourism, and foreign direct investment. And weather conditions that are favorable that support crop production could also lead to higher growth. So again, on the overall, the growth outlook are balanced. On this ground, the MPC noted that although inflation is projected to remain below the target in the near term, geopolitical conditions and policy uncertainty could contribute to increased volatility in economic activity and inflation in the short to medium term. Consequently, the MPC maintained the policy rate at 9.75%. The bands on the CBR remain at +/-2 percentage points, and the margins on the CBR for the rediscounts and the bank rates at 3 and 4 percentage points, respectively.
Raise the MPR by 25 basis points to 27.50% from 27.25%. 2, retain the asymmetric corridor around the MPR at +500 to -100 basis points. 3, retain the cash reserve ratio of deposit money banks at 50% and merchant banks at 16%. 4, retain the liquidity ratio at 30%. Considerations. The meeting was held on the backdrop of renewed inflationary pressures as the headline food and core measures rose year on year in October 2024. The committee was particularly concerned that all 3 measures also inched up on a month-on-month basis, suggesting the persistence of price pressures with attendant adverse impact on income and welfare of citizens. Members, therefore, agreed unanimously to remain focused in addressing price developments. While food prices remain a key contributor to the uptick, members commended the efforts of the federal government for the improved security, especially in the northeast of the country, which would likely improve food production. The committee also noted the role of rising energy prices on the general price level due to its impact on factors of production.